we will also deal with chapter 5, which is job order costing. You might notice that the jacket is off, the sleeves are rolled up. We are going to get into the nitty-gritties of production cost accounting. So I have to again explain certain basic things to you. You will know from GSB 612 what a T account or an accounting account is. Every T account must have 4 elements to it. Okay. So there has to be a beginning balance. So in a debit account, you will have a debit beginning balance. In a credit account, you will have a credit beginning balance. Then in each account, there are inflows during the period that are going to increase that account. So in a debit account, the inflows are debits. In a credit account, the inflows are credits. Then there must be outflows from the account which decrease the account. In a debit account, the outflows are shown by a debit, and in a credit account, the outflows are shown by a debit. And the last element is that there will be an ending balance. In a debit account, there is a debit ending balance. In a credit account, there is a credit ending balance. And the relationship is beginning balance plus inflows must equal the ending balance plus outflows. Now there are 4 unknowns. If you know 3 out of the 4, you can always plug for the 4th one. So I wanted to get the basic nature of an account out of the way. Now I want to start talking again about production costs. Like I said in the last lecture, any cost incurred in a factory is a production cost. There is something that causes confusion for some students, and I would like to clarify that. In any factory, there are production departments and then there are service departments. The actual units are produced by work being done on them in the production departments. The service departments do not work on the units being produced, but they exist to support the work of the production departments. Now, obviously, the costs incurred in the production departments are production costs. What do they consist of? They can consist of direct materials, they can consist of direct labor, and they can consist of manufacturing overhead incurred in the production department itself. Now, what about the costs incurred in the production service departments, not the production departments themselves? Obviously, since these departments are not working on the units being produced, you cannot have any direct material costs in there or any direct labor costs in there. So all the costs incurred in service departments are manufacturing overhead costs. But the important point to remember is that these are still production costs. The distinction between production costs and non-production costs from a financial accounting perspective is very important, because production costs are called inventoriable costs or product costs, which means that there is a possibility that given the situation, they may show up as assets called direct materials inventory or work in process inventory or finished goods inventory on the balance sheet. The last case being where they are shown as an expense cost of goods sold on the income statement, which is the cost of the units sold in the current period. Non-production costs are called period costs. They are non-inventoriable costs. They can never be shown as assets on the balance sheet. They will always be expensed in the period in which they are incurred. So if there is a cost that is incurred in the research and development function in the marketing function, distribution function, customer service function, or any function other than manufacturing, there will be period costs that will be expensed in the period in which they are incurred. All right. In week 1, I had said that one of the basic things in cost accounting is to somehow calculate the production cost per unit. And at this point, I want to introduce a new topic. There are 3 costing systems. When you go to actually calculating the production cost per unit, they are called actual costing, normal costing, and standard costing. And I will show you what the differences are. Okay. Before I do that, let me explain that any cost is equal to some quantity multiplied by some price, right? Okay. So if we look at actual costing, and we will concentrate on the work in process inventory account, there will be a beginning balance out here. This beginning balance is the sum of all the production costs, direct materials, direct labor, and overhead that have been incurred on the units that were incomplete at the beginning of the period. That means they were incomplete at the end of the period, right? So direct materials, direct labor, overhead in the units, incomplete units at the beginning of the period. Then during the period, we will debit the work in process account for direct material costs. Since this is actual costing, the amount that you will debit to work in process inventory is actual quantity used multiplied by the actual price per unit of direct materials. Again, you will debit something for direct labor. The amount under actual costing debited to the work in process account, and by the way, the work in process account represents the factory. So these are the costs being incurred in the factory. It is equal to the actual hours worked multiplied by the actual wage rate per hour. And then in terms of manufacturing overhead, any time we incur an overhead cost in the factory, we will just direct debit it to work in process inventory. So for instance, if the depreciation expense on the factory machinery is $5 million, we will debit work in process inventory for 5,000 and credit accumulated depreciation for 5,000 or 50,000 or whatever I said. If the indirect labor costs are $10,000 in the factory, we will debit work in process inventory for 10,000 and credit wages payable or something for 10,000. But anyway, in an actual costing system, the work in process inventory is debited for the actual manufacturing overhead costs. So, when we are using actual costing, we will come up with a production cost per unit. The problem is that the production cost per unit can vary significantly during different points during the year, and that is called the seasonality factor. Direct material costs and direct labor costs are easy to trace to the units of product because we can use the direct tracing method, which is a one-to-one relationship between a cost and a cost object. The difficulty is in tracing manufacturing overhead costs to units of product. Okay, so seasonality comes in two ways. There are a number of overhead costs that are seasonal in nature. They are very high at some points during the year and non-existent at other. For instance, most factories shut down for between 2 to 6 weeks every year to go through major maintenance. At that point, during that period of time, repairs and maintenance costs, which are manufacturing overhead costs, are very high. During other months, there is just normal maintenance where the repairs and maintenance costs are rather low. Then there are vacation benefits. People don't take vacations evenly throughout the year. Vacation benefits expense, so the factory, which is a manufacturing overhead cost, is clustered around Thanksgiving, Christmas, in the summer, periods of time like that. The point is that it is seasonal in nature. So because of the seasonality in the incurrence of overhead costs, you can come up with varying overhead costs per unit during different points in the year. There is further seasonality in terms of production. Factories do not produce the same output in the same numbers period after period after period. They may have different outputs during different times of the year. They may also have different quantities produced during different times during the year. So again, that leads to a seasonality misjudgment of the manufacturing overhead costs per unit, and therefore the overall production cost per unit. To overcome the seasonality problem, we migrate from actual costing to normal costing. There is no difference between actual costing and normal costing in terms of direct materials and direct labor. Just like actual costing, in normal costing, direct material costs debited to work in process inventory for the costs of the materials used in the factory is actual quantity used times the actual price. Just like actual costing, in normal costing, we will debit work in process for direct labor costs, which are actual hours times the actual rate. But when it comes to overhead, there is a big distinction. Instead of debiting the work in process inventory account for the actual overhead costs incurred, we debit it for a number that is called applied manufacturing overhead. And now I have to show you what applied manufacturing overhead is. First of all, in normal costing, we will create a new account called manufacturing overhead. To determine the applied manufacturing overhead, we have to go through a series of steps. The first step is to create a new account called manufacturing overhead, which did not exist under actual costing. The reason was that in actual costing, whenever an overhead cost is incurred in the factory, it is debited to the work in process inventory account. In normal costing and standard costing, that is not the case. When you actually incur a manufacturing overhead cost, it is debited to an account called manufacturing overhead. So let's say that the depreciation expense on the factory machines was $50,000. The entry that we would make in normal costing is we would debit manufacturing overhead for $50,000 and credit accumulated depreciation for $50,000. If the indirect labor cost incurred in the factory was $10,000, we will take that $10,000 and debit it to the manufacturing overhead account and credit to wages payable or accrued payroll or accrued factory payroll or some account like that. So if you notice, we haven't touched the work in process inventory account. Well, so how do we get to applied overhead in work in process inventory? So as overhead costs are being incurred, they are being kept on the debit side of manufacturing overhead. The credit side, so the actual overhead costs are the debit side, the applied costs are the credit side of manufacturing overhead. To calculate applied manufacturing overhead, you first need to develop something that is called an overhead rate. So, in normal costing, we will develop something called an overhead rate. To be very precise, this is called a predetermined annual overhead rate. Predetermined means that it is calculated before the year begins or as soon as the year begins, and it is the same number is used throughout the year. It is not changed. That is where the annual part comes in. So, it is a predetermined annual overhead rate. Okay. So, to calculate the overhead rate, we use a formula. We start off with the budgeted total manufacturing overhead for the year. You must have developed a budget for the next year. There you can go look at it and find out the number. That is the budgeted total manufacturing overhead for the entire year. This will be in terms of dollars. Okay. Now, wherever there is a rate, there must be a base. So, for instance, when you pay your tuition, it is tuition per credit hour. That is the base, right? So, the base for the overhead rate, since this is a production concept, must be some measure of production volume, budgeted production volume. It must be some measure of budgeted production volume. Volume is a concept like temperature. To be precise about it, you have to have units of measure. So, for instance, like temperature can be defined in terms of degrees centigrade, degrees Fahrenheit, degrees Kelvin, degrees absolute. Similarly, the budgeted production volume can be expressed in terms of output, where it would be units of output, or it could be in terms of some production inputs like machine hours, direct labor dollars. Which one do you choose? You choose the one which in your case is most responsible for the incurrence of overhead costs, since it is the overhead cost that we are trying to capture. So, let us say the production volume is in terms of machine hours. So, these are the budgeted machine hours for the next year. So, once you get using this, you can get an overhead rate. Let us say it is equal to $10 per machine hour. Okay. Now, when do we debit overhead costs to manufacturing overhead? Whenever they are incurred. When do we apply overhead costs from manufacturing overhead to the work in process account? Depends upon company policy. Some companies do it every week, some companies do it every month, they may do it every quarter or whatever. But to get this applied overhead, what you will have to do is this. You will have to take the overhead rate, which in this case was based on machine hours, and you will multiply that by the actual machine hours worked in the period that you have selected. So, you take the overhead rate per machine hour multiplied by the actual machine hours worked in that period under consideration. If the overhead rate was per unit of output, you would have multiplied it by the actual units produced during that period. If it was direct labor dollars, you take the overhead rate per direct labor dollar and multiply it by the actual direct labor dollars or costs incurred during the period. Once you have determined that number, you will show that as the applied overhead. So, in the journal entry, you are going to debit work in process for $70,000 and you will credit the manufacturing overhead account by $70,000. Throughout the year, you should not expect these numbers to be the same on the debit and credit side, and actually if they are, you should report it to somebody like the police because it shouldn't be. But we worry about this at the end of the year. At the end of the year, we have to find out whether there is a debit balance or a credit balance, and these are called over applied or under applied. So let's say the amount applied is 70,000, the amount incurred is 60,000. This is a case of over application. If the amount applied had been less than the amount incurred, that would have been a case of under application. What do we do with over and under application is a question for a later chapter. The most common treatment is to take that amount and close it out to the cost of goods sold account at the end of the period. So, the basic difference between actual costing and normal costing has to do with actual numbers being debited to work in process or estimated applied numbers being debited to work in process. The third costing system is a standard costing system. We will look at this more closely when we come to the chapter on variance analysis. But to be able to do standard costing, you must develop standard quantities allowed for each unit of output and the standard prices for each unit of input. So, for instance, there will be a beginning balance. For direct materials, we will debit work in process for something called SQA, which in total, and I hope you always say it in total because it will help eliminate some confusion. This is the standard quantity allowed for the actual output during the period. Standard quantity allowed for multiplied by the standard price. For direct labor, this would be standard hours allowed for actual output. So, let us say your output is 10,000 units. Under the standard, you are allowed 2 direct labor hours per unit. This number would be 20,000. 10,000 units times 2 standard hours per unit multiplied by the standard wage rate. For manufacturing overhead, let us say that the overhead rate is per machine hour. I would take the overhead rate per machine hour and multiply it by the standard machine hours allowed for actual output. This is not a division, this means per. Overhead rate per machine hour, not overhead rate divided by machine hours. Some suggestions that I can provide to you are skim pages 204 and 209, read them, but then several times very carefully read pages 209 to 216 and 219 to 229. It would be preferable if you read those pages before you saw the video, but now it's a little bit late, so you can go back and watch the video again. I'm actually a pretty funny guy in real life, but it is difficult to do much of that while being videoed, and I also don't want any incriminating evidence out on YouTube or the internet, so we are going to keep this very professional. All right, I hope you're having a good time.